Welcome to Cotality's Housing Market Update for May 2026. Brought to you by onthehouse.com.au. Cotality's National Home Value Index rose by 0.3% in April, the slowest monthly growth since January 2025. Every capital city saw the trend in housing values lose some momentum in April, but the differences are signalling a clear loss of momentum as the housing cycle moves through a turning point. Sydney and Melbourne were the main drag on the headline numbers, with values falling 0.6% over the month. Sydney's now 1% below its November peak, while Melbourne is 1.9% below its November cyclical high and 2.3% below the March 2022 peak in values. In Perth, the rate of growth is clearly cooling, but it's still a strong market. Housing values rose 2.1% in April, adding more than $21,000 to the median dwelling value. Brisbane, Adelaide and Darwin also saw the pace of gains cooling, but from a high base, with values still rising by more than 1% month on month in each city. This cooling trend has been building since late last year, initially because affordability and serviceability were constraining demand, but also a pickup in inflation late last year that weighed on confidence as the RBA took a more hawkish stance. Now, with interest rates higher, a sudden rise in transport costs, and the potential for further rate hikes, sentiment has dropped sharply, adding to the headwinds for housing demand. Lower demand can be seen in fewer home sales. Capital city sales over the 3 months to April were estimated to be 5.4% lower than a year ago and 7.4% below the previous 5-year average. At the same time, advertised stock levels are rising in the weakest markets. Over the 4 weeks ending May 3rd, the number of homes advertised for sale was 12% higher than the 5-year average in Sydney and 3.5% above average in Melbourne. In the mid-sized capitals, stock is tight, but even in these cities, listings are starting to rise, albeit from a low base, and still below typical averages for this time of the year. You can see that demand-side imbalance in auction clearance rates as well. Clearance rates have been sitting below 55% since the last week of March. Growth continues to be concentrated at the most affordable end of the market. Across every capital city, the lower price quartile is outperforming as buyers focus where borrowing power stretches further and where first home buyer incentives matter the most. Sydney is the clearest example. Lower tier housing values are up 2.9% year to date, while the most expensive quarter of the market is down 3.3%. Regional markets are holding up better, but conditions are easing here as well. Over the first 4 months of the year, housing values across the combined regional markets rose by 4.2% versus a 1.8% rise across the combined capitals, helped by lower price points and above-average internal migration rates. Even so, momentum is cooling, with April's rise of 0.9%, the smallest monthly increase in 9 months. On the rental side, there's still no real sign of easing. The national vacancy rate was recorded at 1.7% in April, lower for units at 1.6% and 1.8% for houses. Every capital city is recording a vacancy rate of 1.9% or lower, well under the decade average of 2.5% and a long way from the 3.3% average we saw in the 10 years before 2020. With vacancies this low, rents keep pushing higher, up 0.6% in April and 5.7% higher over the year, the fastest annual pace since October 2024. That's roughly $38 more per week on the national median rent over the past 12 months. Gross rental yields in most capital cities are well below the cost of debt, even before you factor in holding costs. That means new or recent investors are likely to be running cash flow negative unless they've put down a large deposit. Perth continues to lead the nation for home value growth, with the market up 2.1% in April, taking the median about $21,280 higher in April. The 26% increase recorded over the past 12 months is the strongest annual gain for the region since the 12 months ending January 2007, as the market was cooling from peak mining boom conditions. Value growth remains concentrated around the lower price tiers, with values up 2.4% for lower quartile properties in April, compared with a 1.8% rise across the upper quartile of the market. Extremely low stock levels remain a feature of the Perth market, supporting the upwards pressure on prices, but this is starting to change, with a clear upswing in total listings underway, albeit from a very low base. Overall, housing demand is facing a tougher and worsening set of headwinds. It's a mix of cyclical pressures and external shocks, and it's weighing on both value growth and sales activity. Importantly, this slowdown didn't start with the February and March rate hikes. It was well underway before that and before the conflict in Iran. Affordability is at record lows across most capital cities, and serviceability has deteriorated as inflation has outpaced wages and higher interest rates have reduced borrowing capacity. Population growth is also normalizing after the post-pandemic surge, removing a key demand tailwind that supported housing activity in recent years. More recently, geopolitical uncertainty and a global oil shock has added to the downside risk. Inflation data to March confirms the rapid flow-through of high fuel prices to transport costs, and there's likely more to come. With a sharp rise in headline inflation and widespread expectation of higher interest rates, consumer sentiment has fallen sharply. Lower confidence usually translates to fewer high-commitment decisions, like buying property. Historically, sentiment and home sales tend to move together. You can see these pressures in the data. Value growth is easing, auction clearance rates are below average, and listings are lifting in most markets. More choice and longer selling times reduces urgency, and that's gradually creating a more balanced market or even giving buyers the upper hand where stock is above average. At the same time, demand is highly price sensitive. Competition is strongest below the median, where first home buyer support and serviceability limits are concentrating demand. One offsetting factor is new housing supply. Housing supply constraints should provide some support for home values. New dwelling construction continues to undershoot underlying demand, and that gap could widen as higher oil and fuel prices lift construction costs. Another factor helping to offset the headwinds is labor markets, where persistently low unemployment rates are supporting income security and reducing the risk of forced selling. Put together, these factors should help to prevent a sharp downturn. The base case looks like a further loss of momentum rather than a major correction. As 2026 progresses, outcomes are likely to remain diverse, varying by city, by regions, and by price points. If you're buying, selling, or investing, the key is to stay on top of your local conditions and the data flows, not just the national headlines. As always, you can stay up to date on all things housing at the Insights pages of the Cotality Australia website.